Hi, my name is Watson. I'm the head of market risk at Gauntlet. For most of y'all who are unaware, Gauntlet focuses on DeFi native economic research and quantitative optimization. Um, a lot of my colleagues and I came from either traditional finance or big tech or academic backgrounds. And so a lot of the ways that we approach the various economic risks in the decentralized finance space is sort of based in and grounded on various techniques that you'll find in the quantitative space. Yeah, and so maybe to sort of simplify the problem space a bit, most of economic risk analysis and understanding how to break down the problems in the space sort of can fall into balancing risk and rewards. Without being sort of too pithy, this is sort of a pattern that's seen across a lot of various economic models but to also illuminate sort of the ways that you can think about it in the DeFi space. So if you take a lending protocol, for example, what you want to balance is potentially insolvencies and liquidations against capital efficiency and usage, right? So one of the ways that we've sort of quantified the ability to think about insolvencies is like value at risk. So this could be also quantified as the estimated amount of insolvent debt under adverse market conditions, or sort of the 95th percentile conditions of an ecosystem or protocol. And again, you could sort of think of a similar metric for user liquidations. In addition, I think that if you look at DEXs, a risk that they might want to be able to quantify is user impermanent loss. And so, again, without spending too much time on the exact technical definitions, the idea is understanding sort of decay in user positions might be an important metric for a DEX to be able to quantify and optimize over. And then on the reward side, like I said, if you think about a lending protocol, you want to optimize for capital efficiency. So this could be the potential borrowing power of a protocol overall or for a single user. And so this could be the total available borrows based on collateral positions. And you also want to optimize for usage, right? So this is like the amount of supplied capital that is actively being borrowed against. And in addition, for DEXs and other liquidity provisioning protocols in the space, you would also think about sort of protocol revenue and potentially like trading volume. And so again, this is something that Gauntlet has spent a lot of time working on and sort of thinking about in very particular ways. This is sort of a glimpse into our dashboard and sort of some of the metrics that we show. I'll discuss in a bit more detail how we come up with these values and sort of think about these problems in some later slides. And if you also wanted to sort of distill down the various sort of vectors that you would want to think about economic considerations. Again, this is by no means an exhaustive list. This is sort of just to give you specific examples of what you might want to consider, right? So you could think about sort of correlated asset price upturns or downturns. You can think of this as sort of an overall like loan book exposure optimization problem where you would also need to consider sort of cascading liquidations. You could think about broken correlations. So this is like DPEGs and price inequivalence. There's been some pretty extreme examples in the recent past. So you could think of this as maybe a stablecoin DPEG. The sort of USDC price deviation event in March of this year, which I'll actually touch on again later in this presentation. You could also think about staked asset price deviation. So this could be staked ETH on the various blockchains. You could also think about uncorrelated price upturns and downturns. Succinctly, you could call this price manipulation. So I'm not sure if most of y'all here are familiar with the Mango Markets exploit, but the idea is dependent on various pricing mechanisms. There could be market participants that take advantage of flaws in smart contracts, which again is why I think the organizers of the event placed this after the presentation we just had. I think that security is sort of one of the inputs that could potentially lead to various risk vectors that we try to understand how you could solve for. Again, it is not our job to sort of avoid these situations, but understanding what the sort of blast radius and also what market participants can do after you sort of see these events happen is core to how we think about problems. You could also think about sort of single asset liquidity declines. So this could be, you could have like various like token rehypothecation events, or such as with the FTT token, or market maker liquidity decreases. And then you could also think of sort of broad market liquidity decline. So if you take like some bridge hack where then all of the sort of liquidity on an ecosystem is handcuffed, that could also be a very important sort of consideration for economic risks in the ecosystem. And to then maybe jump into Gauntlet's high-level approach, I think that if you wanted more information about sort of how we think about these problems and how we model it, definitely check out our website. I think we've published a lot of far more nuanced and detailed breakdowns of how we want to think about these problems. But the two various steps that you can think of are one, at the very top, sort of agent-based simulations. So what does that mean? We pride ourselves in being able to take in various market and protocol inputs, running simulations, and understanding and defining agents with specific utility functions, and seeing how these systems will propagate and break down in specific market scenarios. So the idea is sort of, if you want to think of important inputs, you could think of sort of volatility of assets. You could think of trading volume, trading liquidity. You want to understand the correlation between assets. You want to understand the borrower distribution on various protocols. And you want to think about how these agents and how these market participants act in various situations. So with that, you could run thousands, millions of simulations in terms of various inputs and market conditions. And with that data, you could then feed it into a distributed parameter optimization sort of problem, right? And so very simply, you want to define an objective function that details what you want to optimize for. Again, generally, you want to think of this as a function of risk and capital efficiency. And when you want to optimize these parameters, there's many ways to solve these problems, but we sort of have determined solving this as sort of a zeroth order optimization problem is computationally efficient. And so the idea is you want to optimize for the various conditions and objective functions that you would define, and understand how to optimally set parameters for these protocols under these various conditions. And I think that something that's worth talking about here that I sort of previously discussed before is understanding what happened with USDC in March of 2023. I think that you can sort of replace this scenario with a broad set of hacks, exploits, market volatility that was actually discussed in the previous presentation and panel, right? So the idea is like, oh, hey, this could also apply to a curve hack. This could also apply to some lending protocol hack where X amount of assets are no longer available to the ecosystem. But in this particular case, I think that I won't spend too much time on the broad implications, but to sort of highlight the timeline of events that happened with the USDC DPEG, I think on March 10th, California regulators reported the closure of Silicon Valley Bank. This is clearly sort of a real-world implication. This is not just DeFi contained, but the effect of this sort of announcement and also this unraveling of events was price discovery in USDC. And most importantly, the price discovery of USDC on various sort of blockchain protocols. The one I'm focusing on will actually be Polygon for one specific reason, and that's because Aave on Polygon at the time had a specific feature called E-mode, where users are given the ability to more aggressively borrow specific stablecoins against other stablecoin deposits. And so in this particular case, because of the exposure that Circle had to Silicon Valley Bank, market speculators began to sell the price of USDC down on chain, and also most liquidity providers who are sophisticated pulled their liquidity. And so it was sort of based off of our internal models and things that we had built out in the past. USDC price depegging was definitely not sort of within the normal sort of market conditions that were foreseen. But in addition, being able to adapt sort of the ways that you look at risk and understand how you need to react in situations is incredibly important. And so I think that shortly afterwards, Circle confirmed sort of the holdings of various USDC assets at Silicon Valley Bank. One of the actions we took during this scenario was understanding what levers existed and how those levers could be used to mitigate risk on the protocol. So one action we took was suggesting pausing the protocol, which again would prevent liquidations for the protocol under various conditions. If you look at the graph on the right, you can sort of see the price of USDC, the liquidity for 2% depth of USDC, and the liquidations and insolvency of USDC on Aave Polygon v3 as these events propagated. So if you think about what the impact of pausing the liquidation of a protocol is, it's obviously very contentious. There's a lot of sort of implications for UX and like protocol ecosystem impacts. But the important piece here too is this statement was not just a bet that the price of USDC would go up. The relevance and the importance of pausing in these specific moments also had to do with the fact that liquidity for flash loans and flash liquidations did not exist. And the analysis that we put out during this time sort of stated, hey, these are very important markers to understand why liquidations will go through and how insolvencies will manifest if liquidations go through. And so, again, without going into too much detail, I think that we posted a postmortem about this that breaks this down far more granularly and technically. But this is sort of the sort of bleeding edge analysis that is important to put out that while these things are happening and understanding how to build out models for the future that take like the flight of liquidity with respect to price movements as well as user elasticities around these events. All of that sort of feeds into our models going forward, and it's important to consider these and understand how to update the ways that you think about these problems in the future. And so, to highlight some of the takeaways, choosing the correct objective function requires understanding the users and goals of a blockchain ecosystem and protocol. Again, this isn't just done by one company. This is done across various communities and with input from various market participants. Risk in the growing DeFi space is not purely additive. The composability considerations of cross-chain protocol interactions and complex user behaviors explodes the problem space. And finally, again, this is a bit pithy, but setting up a structured process and critically think about risk is essential for risk management. Cool, thanks.